we've got Hugh Bickerstaff, who's the MD of Investible, who's, as you heard earlier, has stepped in for Trevor, who's travelling. Investible is an early-stage investment group that provides high-potential founders with financial, human and intellectual capital that they need to scale. Investable's mission is to de-risk angel investment on a global scale, and it takes a very data-driven approach, something we'll be talking about a little later on today. Alon Greenspan, the better-looking Greenspan of the Greenspans around the world, but it's Alon. It's from Innovation Bay, Jelix. He's stepping in for Andrea and Trevor, who both have fallen over today. I hope they both get better soon. Or has Trev gone down?
No, Hugh was stepping in for Trevor.
Oh, sorry, yes.
Yeah.
Sorry, yes.
Yeah. And I thought that Ian was stepping in, but it was Alon, so there was, we had a double switch this morning.
That's all right. It's like GWS and the Tigers at the moment. You know, everyone's sort of moving around. Yes, welcome to everyone who's working today, unlike Victorians. Kylie Frazer, who co-founded Eleanor Venture as an angel investment platform. They have listed their second company on the platform. And finally, Andrey Shirben, who's a very active angel investor from Sydney Angels, who also runs Follow, this, a data-driven early-stage VC firm. Put your hands together and give them all a I'm going to start with a little bit of a helicopter view and just get your take on the temperature, because there was a report out this week from LaunchVic sort of that goes, ooh, it's looking a bit bad. And I know that Pete's report sort of, 5 months ago now was a little bit, okay, the long-term trend is not looking good. Nonetheless, you know, the Innovation Bay report was very positive about the state of investment. Can I just run through the panel? How do you sort of see VC investment? Of course, we'll focus on seed, but broader as well, if you like. How do you see Australia going? It seems like, to me, there's plenty of capital running around. Are the ideas good enough? And you're just waiting for those moments, or what's your take?
Sure. Do we need this, or can everyone hear me? Because it's gonna be a bit weird if we're passing this back and forth. I'll just keep it for the whole time. Otherwise, everyone. Thanks. I'll start with, given that I already have. I think everyone would be familiar with the increasing size of rounds. So the trend in the US has been that the rounds are getting bigger and bigger, which is pushing VCs further down the capital raising stack, which, you know, on one analysis is leaving a gap at the seed stage, which isn't being filled. In Australia, I'm not sure if that is entirely accurate. I think that we are getting better at the bigger rounds, but the VCs are still quite happy to come down and write those early stage checks, particularly if you have an angel or an early stage investor who has packaged it up nicely for them and really created that value. So all of a sudden it looks like an air tree deal, or it looks like a square peg deal. So the macro trends are there, but I'm not sure that necessarily means that there is a dearth of seed stage capital in Australia.
Hugh?
Yeah, we have a model that's a hybrid fund and club. Mm-hmm. So we have a bunch of high net worth angel investors that invest on a discretionary basis, and then we have a fund that raised 22 million and is deploying it. So probably the best measure is how we're seeing the discretionary side, and I definitely have seen in the last quarter our discretionary club investment was down a bit, but it's certainly ramping up for a very active end of year. Mm-hmm. So we've got a lot of good deals in the pipeline, a lot of healthy raises right now. So this is the last chance in the year for most founders to be raising capital, but there's our quality of our pipeline at the moment is really strong. So quantity and quality is very strong.
What about you, Alon?
Yeah, so I agree with you. I think for us, what I see the quality is, I don't want to say up there, but it's always been up there. Great pipeline, and to continue what Kylie said, Peter did a great job accumulating all the seed investors in Australia. There's not that many seed investors. The big VCs will invest, but it's good to have investors like us that do seed, understand it really good. It's a bit different than your Series A and Bs. So We do see a shift towards it. I don't think there are giant seed investors or investing in. Yeah, I see more deals, more seed deals. I don't know what about you.
Yeah, the bridge. It's that bridge to Series A.
Yeah.
The second one that's having more difficulty raising
Yeah.
because they're having difficulty hitting the milestones they need to get the valuation up to a Series A valuation, raise enough capital
Yeah.
to take that next step. But
there's-
certainly seed is healthy.
There's so much. I mean, you quite often hear, VCS, like never bridge, and plenty of investors have that as a rule, no bridging. Bridges are great, like if there's value to be had there and you're confident that it's not a bridge to nowhere and you can get, great terms and you can help them get to the next stage to unlock that next round of capital, then bring it on, like I'm all for a bargain.
Andre, what are you saying?
So I think that if we look at the numbers, for example, that Oz Industry provides once a year, that is taken from all the ECCLPs that report to them annually, the trend is actually that even though the overall market is expanding, but the pace of expansion went down like 5 times from the previous year. So I think it means that we're kind of reaching a plateau probably in terms of the money being, I mean, I'm not talking about the money being available, I'm talking about the money actually being deployed. If we just read the newspapers, then we would think that, all the startups should be swimming in money, but that's typically not the reality. So I think that in terms of money being deployed, it's actually kind of leveling off. Interesting metric that I would have looked at would be how long does it take a company to close a round? So like, for how long they have their round open? Unfortunately, not sure if you guys have this data, but it's very, very difficult to get access to it because most, no one really wants to tell you that they've been trying to close this round for 6 months and they've struggled. But looking just at my personal portfolio and my funds portfolio, I see that it does take companies longer to close rounds, and investors are taking more time to make up their mind, whether they're in or out. So yeah, it would never be kind of a straight line, always ups and downs. I think good startups would always have easier job at raising money, and the ones that are kind of not yet there in terms of the numbers, they would struggle. There is indeed a meaningful gap in between, and it's mostly because at the very early stage, a startup essentially sells a dream. And when you sell a dream, it's a dream. You can't really quantify it because there are no numbers, and you either believe in it or you don't. And either way, the decision is generally fairly simple. But the moment you're starting to have the numbers, then everyone forgets about the dream and everyone starts looking at the numbers. Now the problem is that until you reach meaningful numbers and meaningful traction, well, these numbers would still not stack up into anything that you can translate it into reasonable valuation, but the investors would get fixated on these numbers. By the way, same thing happens on ASX, so it's not just a startups problem, but I think there are challenges there, but I prefer to be optimistic typically. So I think especially looking back, I came to Australia in 2010, and there was literally almost nothing here in terms of there was definitely no ecosystem, no tax-free club, no fish burners, nothing. It took me a whole 2 years just to find my first investment to make in Australia. And fast forward to today, I think the progress that was made is quite phenomenal, and I think that the pace of expansion naturally slows down. The more mature the ecosystem becomes, but we still have a lot of room to grow to. So.
Can I get the 4 of you just to give us the 90-second pitch for you guys and what you do, just so that the people who are looking for funding have an understanding, whether you're in SaaS or you're all looking for some sort of plant-based meat, or what's going. You want a pitch deck with 153 mentions of tech in it, just give everyone an understanding of how your model works and what you're looking for.
Can I just ask, have we got is it mostly investors or mostly founders in the room? Because from the show of hands, it looked like it was mostly investors.
I think it's mostly investors.
Mostly investors.
Founder.
Okay. So both sides are nice.
Good, yeah, good.
Right. We'll do it both.
Two-sided marketplace.
Yeah. So no pressure there. So Eleanor started as a private syndicate about 2 years ago, but we flipped up to a public syndicate about 4 weeks ago, so we are brand new and still figuring it out. We've focused our kind of innovation on the investor side, letting people write checks as little as $5,000, so you can really build a diversified portfolio and not have to learn by writing 25k, 50k checks at a time, because that's how I learn. And you make mistakes and it hurts. Like no one's, even if you are loaded, you don't want to lose 50k. Every time you take what is essentially a bet. On the founder side, we will look at anything that has a compelling story. We are in the dream. We are in the business of buying and selling dreams. We like to see some signs of early traction, but we are looking for storytellers and people who we think we can help. Sector-wise, we will look at anything except crypto.
Andrey?
All right, very quickly. So I'm an entrepreneur and investor. So I started building companies when I was 19, and I basically never stopped since then. Started 20 odd companies, but I actually crashed my first 8 companies in a row. So it was quite an experience. Eventually, some of the companies didn't quite crash, gave me some funding, so I started investing in other companies. And to date, I made a bit more than 100 startup investments spread across Israel, China, Australia, US mostly. And I run a few investment vehicles. So I run Seed Ventures, which is a pre-seed stage investment company. I run Follow the Seed, which is an algorithmic global venture fund. And I run Gravity Capital, which is blockchain-focused vehicle. So basically, I do look at almost everything, but we do tend to focus on capital efficient companies, which typically means that we wouldn't look into life sciences, clean tech, pharma, and stuff like this. So we're not in the game of writing $50 million checks and then waiting for 10 years to see whether it's a good investment.
Oh.
Yeah, so at Jelix we invest our own funds, we're early stage investors, like the one here. We invest our own funds and invite others to invest alongside us. We run syndicates at Kylie. We're in between Investible and Kylie, I'd say. We're running syndicates. We're currently raising our first fund. We're going to have you'll talk about your model, we're going to have a relatively similar model, but not the same. Our investors, sophisticated investors, can write checks not as low as $5,000, but $10,000. We source the deals, we run the due diligence, negotiate terms, and offer it to our syndicate members. We invest in pretty much anything. We're sector agnostic, but not anything. We don't really do life science because it's a bit too long for us. It takes quite a long time to commercialize it. We invested in hardware, software, in pretty much any sector, ed tech, retail tech, legal tech. We've invested together. And yeah, I'd say the current process with us, it's a relatively long process with any early stage investor. And we invested in 13 companies and led 17 rounds for the past few years. And we've been doing it for 4 or 5 years. So yeah.
Investible, we started informally in 2010. We're all ex-founders ourselves. So Creel, Price, Trevor Folsom, myself have all been founders and grown and scaled and exited businesses and began investing. Over that period, we have a portfolio of around 85 investments. The IRR on that portfolio is running at about 67.2%. So it's been quite a successful portfolio for particularly some of the earlier investments. Today we have the fund and a club of around 60 high net worth angels who are very active. So we have a sort of model that caters for investors who are active and some that want to be more passive and just want exposure to the sector. And we invest in all seed to Series A, and we invest sector agnostic. Again, we don't do anything that requires deep research, life sciences, biotech. I don't understand it, so shouldn't be investing in things we don't understand. We do leverage
That's the government's job.
Yeah, that's right. We do leverage our club members' domain knowledge and expertise. They're a very diverse group, which really helps us, get them involved in investments where we don't have, deep domain knowledge. We can draw on that, which is a real benefit. The fund does a lead check, usually 250,000 to 500,000, and the club will often follow on from that check with up to another 1.8 million. So, sometimes we do 2.5 million. Sometimes it's only 200,000. So it just depends on how well the business resonates with the club group.
So anywhere between 50% and 20% in terms of total.
Yeah, and we curate those opportunities on a quarterly basis and show them to the members.
Can I ask a question? I know I'm supposed to be answering the question.
I'm not Tony Jones. You're allowed to ask questions in this panel.
So I'm super curious with you guys. So I am new to the public syndicate mob, and my experience was kind of curating deals for a group of about a dozen high net worths who I knew what they wanted to see. But now all of a sudden I've got, this much larger group of investors who all want to see something different, and I'm trying to figure out what they want to see, and I'm struggling to get it right, because everyone wants something different. So I'm really interested to see how you guys have been doing it for longer. How do you know what people want to invest in?
Can I just to add to that, because that was going to be my next question. How do you? No, that's all right. No, they're actually really complementary. How do you guys go around finding the deals? Do you have people come to you? Do you spend all your time wandering around the startup hub, sort of peering over people's shoulders, going, "What are you doing?" Or what's your process and analysis for the investments that you have?
Yeah, so we go on panels.
Become famous?
Yeah, pretty much it. We go to all the events. We have a great deal flow and pipelines through Innovation Bay as well. If you haven't heard of Innovation Bay, please search it. It's a free meetup for angel investors and startups. It's great. I don't know, word of mouth. Being around the ecosystem, we definitely don't just stick around here trying to find startups. It's usually the other way around. Startups approach us. With that, you can actually apply online on our website. You're welcome to do it. Apply, put your name, what you're doing in business, and we'll reach out to us. It's never too early. Please reach out. We're always happy to grab coffee with founders. And in terms of answering your question, in a way it's a numbers game with syndicates. And so for us, we invest our own funds. So if we don't like an opportunity, we want to invest, and we make the decision for ourselves, and then we invite others to invest alongside us. So if we're not interested, we won't offer it to a syndicate, and if we think it's a compelling case, we will offer it to them. But we can tailor it for each investor.
Well, that's exactly what we do. We're balance sheet investors first and foremost. But just trying to figure out what, and I guess that's why you guys have raised the funds to help round that out.
Yeah, I mean, we run a lot of events. So we run pitch events for the Overseas Talent and Entrepreneurship Conference for the Beijing government. So we run them right through Asia, Singapore, Thailand, Malaysia, KL, all around Sydney and Melbourne. We run also the Investible Games, which is coming up in Sydney in a few weeks.
Which is kind of
I should know the date, but it's
a massive brand in itself.
It's pretty awesome.
Yeah. So the Investibility Games is like a 2.5-day accelerator. So we figured that most really good founders don't want to spend 12 weeks and give up equity and pay money to get feedback on their business model and to meet investors. So we run a 2.5-day program. We don't charge anything to the founders for being involved in that. They do 10 challenges over those 2.5 days. So we sort of like Tough Mudder for founders, or Hunger Games sometimes. But we bring in a lot of investors to give them feedback and coaching and judge the different challenges, but they do it in like 2.5 days. So we find that's good for, we get something like 120 applications for that. We put the best 12 in there, and then it's great due diligence for us as well as investors to see founders under pressure for 2.5 days, having to do these challenges. So we do that, and that's kind of fun. We get most of our leads through referral from our existing founders and from our investor network and from the VCs. My friends here, we co-invest quite often, and some of the best opportunities should be coming through co-investment. I don't think it's actually as prevalent as it should be.
I think it. I mean, that's where nearly all of our deal flows come, both as the private syndicate and the first couple of the public syndicate have all been VC-led deals where they just need a bit of fill. And we run our syndicate really quickly. We only open our deals for a week, so you get in and you get out. So that's been really easy. We do all the usual stuff by trying to create the ground up stuff. We take blind applications. You don't need a referral, all that usual stuff. But we like the bridge. There's a real opportunity for that ugly stage of capital if you can write checks quickly and bring them together a crowd. Particularly when you've got like a good big VC who's had a 2-year relationship with the founder. They've done all the diligence. You can make a really quick decision. And knowing, so I do mentoring at StartMate. Shona does mentoring at Springboard. So you do, and I think we're all on different kind of accelerator programs. It helps to have those relationships over a long time. It's really hard to come in on demo day and pick your favourite. You've got to have those relationships. You've got to see how people go under pressure, which the Investible game sounds like it does a great job. But knowing you can't mentor at every accelerator, you'll drive yourself crazy. But you can have friends at every accelerator and kind of go, hey, who coped, who's still the same person, who's still selling a consistent version of themselves. I don't care if they've changed the product, but who is still consistently themselves at the start of the process and at the end of the process, and how is that team going? Because one of my main jobs at StartMate is to coach founder breakups. Like I am the founder breakup extraordinaire. Not in terms of getting them to stay together, but in terms of extricating them in a fair manner. Like should have been a divorce.
I think we've got a new Netflix series out of today already.
Oh, it's tough, right? Like it happens all the time, and accelerators accelerate. All the shitty parts of a relationship. So if you see a great team that has gone through that and is still strong at the end, that's really cool signaling for us.
I think the other thing, just from the founders and investors' point of view, is just put some idea around the numbers. And the numbers, we get 1,200 applications for capital a year. So, around 1,200 decks come in from various sources, and we see probably, can't do 1,200 cups of coffee. Yeah. So we see about 300 out of the 1,200, and then we bring that down to probably around 60 that we do light due diligence on, which will get down to about 45 that we do heavier due diligence and take to the IC, and we'll make 15 to 20 investments a year. So, from a founder perspective, don't take no's. You're going to get some no's. You've just got to keep finding and look for the right investors and improving your deck and improving your proposition.
I'm going to be cheeky for a second. Have you had I should have signed the Beatles moment in all of those, Hugh?
Like someone I regret I missed out on. Yeah, there's a couple, but I don't. I don't worry about it. I think it's fantastic that they've done really, really well. Yeah. But yeah, there's been a couple. I mean, there's one recently. They probably won't mind me mentioning their name, but there was one that I was in the seed round, very early seed round with them. And as timing and circumstances happen, they filled the round. with a single investor group, and so I missed out, and I was a bit devo about missing out because I thought they were, really a good company. Anyway, I kept in contact with them. Every time I saw something in the media that they did, an achievement or something, I sent them a note congratulating them, saying how well they did, and so on. And then about a year later, they came back for their next round, and it was going to be a closed round. All their existing investors were following on because the business was going well. But they reached out to me, and we got in. We put in a $1.5 million investment in that next round, which is great. So, again, that's about from a founder perspective, it's about investor relations. You need to develop those relationships with investors and maintain them, keep them up to date on your progress and how you're doing and what's going on, and so you have a future investor list, that you're working with.
And just to add to that, it's the other way around as well, yeah? So for us, especially for early stage investors, we want to feel comfortable with the founders, with the market. We're sector agnostic, most of us, yeah? So we don't know everything about your market. If there are founders here, we'd like to get to know you for a while. Just keep us, if you have stakeholder updates, do your own DD on the investors. Don't just, send out cold emails. Hey, this is my deck. Are you interested? Do your own homework. Check us out. See if there's a fit. We'll see if there's a fit. If there's a fit and it's too early, keep in touch. Add us to your stakeholder updates. If you have GBU, good, bad, ugly, which I love, always share with us as well. And another to add to that, I get a lot of, so we see probably through Innovation Day and Jelix, probably 1,500 a year. And I get a lot of NDA requests as well. And we just don't have the time to sign or look at NDAs. We're not going to compete with anyone. And if we disclose information, it will damage our reputation. So generally, I'm not sure what about you guys, but we don't really sign NDAs. We'll never disclose anything. So yeah, just bear in mind, we get a lot of decks, and we just don't have the time to look at NDAs.
Andrey, what about you?
Yeah, so I share the feeling here. I had this problem of getting a couple thousand approaches a year up until maybe 4 years ago or so, and I realized that I'm actually spending too much of my time meeting the wrong people, and it took me a while to figure out how to solve this problem. And eventually what we've done is, together with my partners in Follow the Seed, we basically built an algorithm and managed to automate the process, at least in the kind of consumer internet space, to the extent that today any startup anywhere on the planet can basically pitch us automatically through just hopping on our website and downloading an SDK, which is a small piece of code, plugging it into the product, and then within 3 weeks, our algorithm has enough data to analyze, and then it trains them. So we have an algorithm that's called Raving Fans, and it's built on the research that my Israeli partner did for 20 odd years around the area of consumer behavior, consumer psychology, irrationality, and stuff like this. And basically, once this algorithm scores a company, or it scores a product, not a company, above a certain threshold, then one of us reaches out to them. So we basically save the time and save all these cups of coffee, which I, by the way, don't even drink. But it can easily occupy most of our day meeting founders. In our case, especially because it would take pitches from anywhere on the planet, and the whole other reason behind developing an automated platform is that we believe in democratizing access to capital, because we think that today is, it's being this way for 50 years, it didn't really change. It's still way too concentrated around the major hubs. And even in the States, if you're in South Dakota, well, good luck at raising funding. But obviously, if you're in Silicon Valley and you went to Stanford, or you worked in Google or Facebook or Amazon, or Amazon in Seattle. But anyway, your chances to raise funding are much bigger. And
Investment, as long as you can get above 4.8 or something like that, get in.
yeah, in pro terms.
I want to sort of just get an idea from the panel of the quality of the deals. When I hear from you, Hugh, you know, of the 1,200 that come across the desk, you probably get down to like DD on about 4 or 5%, and of those, 2% are invested in. Is there this massive bucket of great ideas swirling around, or is there a lot of, like I said, people coming to you with Uber for, and it's like, oh please, you know, I'm disrupting sort of, you know, people walking down the side of the street or whatever.
Yeah, I mean, it's a enormous variety every day of what we see, I guess. You know, the quality in terms of what we see also varies greatly. But you know, there's a million ideas out there, but the ability to execute on those ideas and the team to be executing on it and so on is a lot rarer. So you know, the idea is good. To me, I look at the quality of the problem rather than the solution. So I talk about, you know, look at what is the product solving, what is the problem the product solving is always interesting to me. So if it's something that's not really going to be dramatic, you know, I lose interest pretty quickly. If it's something that could really have a massive impact, that's good. Then I go to the founder and the founding team to have a look at, you know, have they got domain experience, have they got passion, have they got experience, and you know, have they been able to bring people in around them that are going to go on the journey with them in terms of advisors and teams and people they're working with, are they coachable? All those sort of elements are very, very important at seed stage because you're really investing in the founding team. And then the business model and the product will change and can develop if you've got a fantastic team, you know, driving what looks like a good idea.
Can I ask the panel, what if you're going to give founders one piece of advice before they start talking to you, what would it be? Sort of what piece of homework they need to complete before they sort of get in touch?
Tell me a story. You know, stories have beginning, middle, and ends. Alan Jones wrote a great blog post on this.
Oh, yes.
So if you haven't,
The nice one.
read it, yeah,
Yeah.
the nice Alan Jones. And you know, I was like fist punching as I read that. And we're at Startmate, we're kind of in the middle of pitch practice at the moment, and you know, just seeing the difference in the storytelling as you take the founders through that process, it's so important. And I don't see 1,500 a year, but you know, I see about 500. You know, I guess there's two kind of theories. One is, you know, VCs want to see decks in exactly the same format because they want to take the metrics out, right? You know, like if they all look the same, then the VCs can compare apples with apples. But you know, we're early stage investors. We invest in the story. So tell me a story.
I agree regarding the storytelling. But when I meet companies, it's not about the pitch. I agree. I want to hear that you're solving a massive problem. You have a great solution. I want to see that you know your market, your business model, the potential business model, competitors as well. Just do your homework, be ready. You don't have to pitch necessarily. Just have a chat. Tell me about the industry. Tell me about yourself. I want to know more about yourself, about your co-founders. And to your other point about the quality, the fact that we view so many companies but we only invest in a small portion doesn't mean that the quality is down. We're sector agnostic, we invest pre-seed, seed A. Across many sectors, statistically you will get many companies. It doesn't mean that the quality is down because we only invest in a small percentage.
Andrey?
So, it would probably be two pieces of advice, but let's say that the second one is kind of a derivative of the first one. But I would say, and Alon mentioned it previously, the most important thing is do your homework. And when you're pitching me or you're pitching any other investor, you need to be able to articulate very precisely why you're pitching your startup to me and not to someone else. Well, in fact, I know that you're actually pitching it to someone else as well. But anyway, and typically what happens that the founders are, I mean, I would say lazy, but they're mostly, running out of time and trying to juggle a whole bunch of things, but they quite often focus on things that are less important and then forget the ones that are more important, and that's significantly affecting their chances of raising money. I'll give like one specific example. I think it only happened once when I invested in a company that pitched to me on LinkedIn. Just was like random email or random connection request, but it was articulated very well, and there was a specific reason why he's reaching out to me and why he asked, to have a chat. And then we had a chat, and I was here in Sydney. The founder was coming from Beersheba in Israel, which is like in the middle of the desert there. I'm not sure how many people know Israel, but it was really out of nowhere. We had 2 Skype conversations, and he got the money. Now, when I visited their office a few good months afterwards, I've seen something that I was really amazed, and then I then understood why it actually worked for them. But in their office, which was, by the way, like an apartment, wasn't like a real office, but in the living room there was like a wall, let's say more or less this size. It was all full with a bunch of A4 pages stapled to the wall, and each bunch of these pages was a profile of a particular investor. They had like about 80 of them. Every investor, they knew their history from whether they were entrepreneurs previously, what companies they started, in which companies they invested, which verticals they're interested in, what are their hobbies. They really did intelligence work on every person they were talking to. And when you do that, you increase your chances of at the very least having a productive conversation like 100 times. And of course it takes time, but if you don't invest time in that, it's like you're not appreciating the time of the person that sitting on the other side of the table, or on the other side of the Skype call or whatever. And then you just doing yourself a disservice. So that's I guess that's the number one suggestion. And the other one, which again, if someone would do this research on me, they would pretty much know what things they need to focus on, because I talk about it, very openly, at events, at blogs, at interviews, and we just write about it very, very openly. And one real thing is that I say ideas are cheap. I'm not interested in ideas. I have, thousands of ideas when I wake up in the morning. They're all useless, even though they're my ideas. But the only thing that could be useful is that one thing that you actually take and you do something with it. But more so, idea is not the main thing. The main thing is the problem that you're trying to solve. And if you can't properly articulate the problem, and the people or the organization that would care about it and provide particular references to not just you think they care about it, but they're speaking about the fact, you're just probably working on the wrong thing. And in my eyes, that's the core, that's the essence of it.
Hugh, I think that was kind of...
Yeah, there's a lot of solutions looking for problems, right?
Changing the consciousness of renting a desk is not necessarily the solution. Yes, question here.
Yeah, I've got a question. So we know when people go, we're talking about a big problem, right, that you want people to be solving. So if you go through the lens of a VC, we know VCs filter because they've got to get VC returns, right? So they're looking for the 1 in 100 or 1 in 1,000 company that's going to return their entire fund. If you're coming at it from an angel perspective, from an early stage perspective, what are you looking at the same filter? Like, I'm looking at you, company X, to return my entire, fund. Have you got the same lens that you want these big problems? And if so, how does that fit into the Australian small to medium business kind of profile that we seem to carry?
I'm happy to go first. So, I actually, again, I wear multiple hats, both as an angel and as a VC. But obviously I started as an angel, and I was always looking for things that would return at least 100x the capital. And it doesn't necessarily have to be a big idea, because like, I mean, we're coming at such an early stage. I mean, at least like I'm used to be the first investor in most of the companies I invested in. Most of them came to me when they didn't even have a pitch deck. They had like a one pager maybe, and in most of the cases it wasn't even that. So like, I mean, it wouldn't need to be $1 billion exit in order to get me that 100x return. But that, I mean, from my perspective, like at the end of the day, I'm not running a charity. Like, I mean, I'm trying to invest in things that, you know, would do good things to this world. But at the end of the day, if I'll run out of money and I won't get my money back, well, then I'll just stop investing. So I think that at the very least, I want to keep on doing what I'm doing because I'm enjoying it. And because of the risk that I'm taking, and I'm not talking about the financial risk. I mean, I'm happy with that, but the risk of you know, investing at such an early stage, and I know for a fact that at least 80% of my decisions would be the wrong decisions. The only problem, I only know about it, you know, in hindsight, so it's kind of not really helpful. But without having such a steep return target, I wouldn't really be able to do what I do. And I think at the end of the day, on average, I'm happy with 10x. But again, in order to get to 10x on average, you definitely need to get the few that are gonna do, you know, more than 100x, because the vast majority of them would do exactly 0.
Mm-hmm.
Yeah, I mean, angel investing, if you're trying to hunt unicorns, is a very dangerous sport. You know, you get seduced by a founder or a pitch or a deal and put too much into it too early without a portfolio approach is, you know, definitely a road to never doing it again. You know, and that's not good for any of us.
Mm-hmm.
So, you know, we sort of say, unless you've got 30 early stage investments, you're still gambling.
Mm-hmm.
So it's very important to spread. And when you do spread your risk, you're looking for businesses that provide the opportunity for thrivability. So, you know, they could scale enormously and be a unicorn potentially, but there's also businesses that have really strong survivability and the ability to provide solid cash flows or you know, a 10 times return and be a great business and get a trade sale or an exit early or something like that as well. So when we try and, you know, balance our portfolio, we're not just hunting unicorns. We're not looking for thrivability all the time. We like to get businesses that you know, are a mixture. And a lot of people have said to us, with our IRR of 62.7%, oh, that's all just because of Canva, or it's all because of Ipsy or one of the early investments. So, you know, I did the exercise of backing out our top 3 investments from the portfolio, and it still had an IRR of 38.2. So, you know, it's got a solid middle ground. And we've had 12 write-offs or more in that portfolio as well. So you know, you need the ones that are going to provide the super returns, but you know, you're not going to get one of them if you only invest in 6 startups. You know, generally you'd have to be very, very lucky.
Yes. So don't rely on Steve Smith, your sort of batting lineup.
That's right. Yeah. And I guess just to finish that founder one as well, because you don't get that founder one, and I think it goes to what Andrey was saying and Alon earlier. You know, the common failure is, you know, not planning your capital raise. So you talked about capital raise being open for a very long period of time. You talked about not doing your research and stuff like that, but really you have to plan your capital raise. You know, and plan when it's going to open, when it's going to close, and who your targets are, and that you've got enough targets, and don't start with your best targets in the first week, because you're going to get lots of good Q&A through the early meetings that will form your ability to answer those Q&As much more strongly in the later meetings. So I just see a lot of founders just don't plan their capital raise. They just rock in, you know, get their pitch deck out and, you know, pitch and then walk out and wonder why they didn't get investment. But it's very important to plan.
I love drilling down on these guys, but does anyone have some questions? See, Tony's got one.
Yeah,
there.
so I'm looking for a bridge, hopefully not for bargain.
Bridges are us.
Yeah, I'll be talking to you. And obviously, as we see the stats, it's the early stage is sort of a bit smaller than it was 12 months ago. That's what we found. I'm also looking at different ways to get light in the funnel in terms of different angels coming in, so that we get the right rate for what we feel we deserve. One of the stuff we're looking at is crowdfunding, just to get more awareness. I don't know, it's probably not the right question, but I'll throw it out to you guys. What is your opinion? Is more crowdfunding more of a PR tool just to get your idea out there? Or as an investor, would you see something online that's doing crowdfunding, and would you look at it seriously?
Can I add to that layer? How important is profile before a company comes to you? Do they need to work on that before they turn up, along with the crowdfunding question?
I guess one thing that it kind of follows, I agree with what Hugh said about planning your capital raise and don't speak to your ideal investor first, but you also need to create scarcity. If everyone can buy it, no one wants it, and the same goes when you are selling your own securities. So you don't want your dealer to feel shocked. And at the moment in Australia, crowdsourcing has a tendency in a lot of circumstances to feel shocked. So it can be very hard to go from crowdfunding to VC. There are a number of great exceptions, and there are new platforms that are kind of trying to change that perception. But I think at the moment that's where we are.
There's been some really success stories lately with a couple of crowdfunded raises, and I think it's because really there was either a customer base or a party of people who felt really passionate about what the business was doing. It might have been an impact investment or something like that. And
or a distillery. Distilleries go great on crowdfunding.
So that's it. But I mean, if you're a traditional sort of startup business, I would tend to try and fill the last of my round potentially with crowdfunding. Once you've got your lead investors and your anchor investor in, maybe look at crowdfunding as a pathway to complete the last party round. But I think if you lead with crowdfunding, that you're really going to restrict yourself to probably a limited investor base.
Because the sophisticated investors will want to be. Yeah.
Well, I think scarcity and definitely it has an impact.
You're going to spend a lot of time sort of raising cash at 10 grand a go too. And I'll just tell you a quick anecdote. Rhino Hide, which I sort of was following for a story for the last few weeks, that first round went gangbusters, completely oversubscribed, closed it early on the crowdfunding campaign they were doing. So they decided to go back for another $500,000. And when I looked this morning, they are just a little over 20% of that one. So suddenly it goes from the story of everyone wants in, everyone wants to buy, to we're bored with you now. And it's kind of like, that's a really, really dangerous quick run because it's all so public.
And who do you want on your cap table?
Exactly.
That's it.
Question up the back, yep.
Today's discussion has touched on the importance of profiling and intel work that you recommend that people do. So what process do you guys use in the criteria to build confidence in a particular space or sector? So how do you measure that and its relevance for the future?
I can't be an expert obviously in all the fields, and I would be the first one to admit that I actually have no idea. I'll give you an example. That was actually my first investment in Australia. A couple of founders that I met at the Seed Start conference. It was probably the second Seed Start back in 2011. And they were pitching this idea about that included ground transport. And afterwards I spoke with them and I told them, listen guys, looks like you have a good team and some interesting background, but why the hell you're tackling such an ugly industry? Couldn't you pick up something a bit more exciting? And then they basically educated me on how big the market is, and not just that, about how big the problem of aggregation in this market is that was solved in every other transport market, but not on the ground. So I'm always happy to learn, and I think that I actually want to be told the right story by the founders. Of course, I would then, like I'm personally intelligence officer by trade. Like, I mean, I served in the Israeli military 6.5 years and doing exactly that. So I know how to validate the data and gather information from, public and not so public sources. But I do want to be told this story by the founders because it's part of my validation of how good they can sell it to someone else. Because even if they can sell it to me, later on they'll have to sell it to other investors, to their customers, to channel partners, etc.
So just to add to Andrew's point, so we obviously do our own due diligence and we collect data from different sources, but as early stage investors, and especially as sector agnostic investors, we don't know all the markets and all the sectors. So we back teams. We back teams and we trust that they understand the market, and we rely on them to a certain extent, yeah. And the storytelling then comes into effect. Customers, investment, but also the market. So to your question, we do our own due diligence and we check it, but we can't be, and we probably won't be experts. And that's why we back the right team that we believe that has enough expertise, domain expertise and knowledge to tackle that market.
So what I wanted to know is how do you validate, and are you using some sort of data to map and to create some assurance that you're selecting your spaces or your sectors?
We have Techboard and many other data providers, as Andrew mentioned, public and not public, that you can get data from.
Because you're very specific about what sectors you work with.
So we actually use on top of the algorithm that I described before, which basically assess the actual product based on the interaction of consumers with it. We also have another part which addresses typically kind of the enterprise software stuff, which we call RPS, reverse problem solving. And that's kind of flipping the whole investment concept on its head a little bit. So basically what we do first, before even talking to startups, we go all around the world and we talk to our contacts in Fortune 500, Global 1000 companies. I'm talking at the highest levels. And we're asking them a very simple question. Tell me about the top 3 things that keep you awake at night. I'm not interested in number 20 on your to-do list because I know that you'll never get there. You're in a corporate, I know how corporates work. You guys can barely, get the first thing on your list done. But that's kind of forms a database of problems that later on when we're talking to startups, it's very easy for me to validate because if they're pitching me, hey, that's the solution and that's the problem, I can tell them, yeah, I'm spot on. Bank of America, Chase, yeah, they all have this problem. I mean, I was talking to their CTO just, last week. And if we don't see this problem, it not necessarily means that it's a bad startup. It just means that we probably can't help them. Therefore, they should go elsewhere to seek funding that would add some value that we can't add.
I'm just going to take a quick final question from this lady here, and then we are going to finish up because Pete's got some awards to hand out to some angels.
You mentioned earlier the startups are struggling to meet some of the milestones needed to get to the next sort of Series A. In your experience, what are some of the reasons they're doing that, and how do you help them overcome that?
Well, there's a lot, I guess. The reasons is usually, they haven't found product market fit yet, so they're still testing and trialing and doing things, and may end up having to change the roadmap for where they thought they were going to go, based on getting additional feedback from the customers and so on. So usually they're struggling to find product market fit, so they haven't got the validation around the usage or the acquisition, cost of acquisition, the unit economics of their business. And the other one is that it takes longer to do stuff than you think it's going to take. So they project based on achieving certain things, and it takes longer to hire people, find talent, do whatever they've got to do to actually hit those milestones. So I think quite often it's just creep. We work pretty closely with them to help them find talent. So we have a talent acquisition manager who works with all of our portfolio to try and make sure that they find talent and the right talent, and we maintain a bank of talent for them. So that helps that one. We partner with a lot of companies who are really experts in digital marketing, and we also have a peer-to-peer group of founders, so they meet every month, and they bring speakers in, generally founders, not service providers, who have been through the journey before and have scaled globally or attracted incredible talent or developed a good culture. So we're trying to help them develop from that point of view as well. That's a few ideas.
Yeah, I think the response is actually quite simple. I'll paraphrase Einstein, who said something along the lines of, in theory, there is no difference between theory and reality, but in reality there is. So I think the thing that happens is that just, reality kicks in, and things just don't go according to plan, because you can't plan for all the things for all the unknowns. Like, I mean, there are things that you know, and that's what you're planning for. Like, if you're a good planner, you're also planning for some things that you know that you don't know. The biggest problem is for the things that you don't know, and there are like 10,000 of them. And even startup founders who've gone through this journey multiple times, they always run into these new things that they haven't seen before, or time just changed, and because of that thing, I never look at the financial forecast. I just take it as it is, chuck it in the bin, because I've never seen a company that actually hits their financial forecast, and I'm talking about my best companies that invested in, that became billion-dollar companies. Not a single one of them hit their forecast. But I know them. If they're young, they don't know it yet, but hopefully I can help them realize that.
I think on the notion of the unknown unknowns, it's probably a good time to call an end to it. Can you please put your hands together and thank you?